Good afternoon. Welcome to today's UHY Advisors webinar on the Wayfair decision. Before we get started, let's go over some housekeeping items. As always, please keep your cell phone mute throughout the presentation. You can download the handout by clicking on the Handouts drop-down button. Please submit any questions you have by clicking on the questions drop-down and then typing them in on your screen where indicated, and then hitting enter. At the end of the presentation, we will answer as many questions as possible in the time allotted. If we do not get to your question before the webinar is over, we will follow up with you to make sure that you get an answer to your question. I would like to remind you that today's webinar does not qualify for CPE. However, we would still appreciate if you complete the questionnaire that will be emailed to you after the webinar. Now, with that out of the way, I'd like to say that today's speaker is Rich Manabach. Rich is Director of State and Local Taxes in UHY's St. Louis office. Rich has 30 years of experience in state and local tax, which includes 6 years in public accounting with UHY and PricewaterhouseCoopers, and 24 years in the corporate tax departments of several Fortune 500 companies. Rich is a graduate of Washington University in St. Louis, where he majored in accounting. He received his MBA from St. Louis University. Rich is a CPA licensed by the state of Missouri and is a member of the AICPA and the Missouri Society of CPAs. Please join me in welcoming Rich Manabach.
Hi, thank you, David. Good afternoon, everyone. Thank you for attending the webinar. The Wayfair decision and its impact is probably the most significant development in sales and use tax that's occurred over 25 years. It has far-reaching implications for many businesses, and it's not just limited to e-commerce. So what I plan to discuss today is going to cover what the nexus is, what the types of nexus there are that exist, where we were prior to the decision, what changed with the ruling and the state's reactions afterwards, and then I'll also go over the impact to companies who have interstate operations and what steps they may need to take to ensure they don't run afoul of these provisions. So, moving in. What is nexus, basically? So nexus is just, basically it's an all or nothing concept that's based on the degree of contact an out-of-state taxpayer has with the state. So it requires an out-of-state taxpayer to have a sufficient degree of activity in the state before that state can require the taxpayer to collect sales and use tax. Sales and use tax nexus, however, does not follow the same rules as income tax nexus. So you can't really, if you have one, it doesn't necessarily mean you have the other. The states control the imposition of sales and use tax with guidance and restrictions from the United States Constitution. And there's really two parts to that. The due process clause of the 14th Amendment, which says no state shall deprive any person of life, liberty, or property without due process of law. With respect to the state taxation, the Supreme Court has interpreted as to prohibit a state from taxing a corporation unless there's a minimal connection between the company and the state in which it operates. Under this clause, the seller must have a minimal connection to the state. This is a very low threshold in most cases. The other one is the Commerce Clause, and that's from Article 1, Section 8 of the United States Constitution. And that allows Congress to regulate commerce with foreign nations and among the several states. The Supreme Court has ruled the Commerce Clause prohibits states from enacting laws that might unduly burden or inhibit the free flow of commerce between the states. This is historically a higher standard for imposing transaction taxes, and until Wayfair was decided, required a physical presence and a substantial nexus for sales and use tax collection. So this is really what Wayfair is all about. So then where were we kind of underway before Wayfair? And this is just to understand where we're coming from. I think this is a good thing to understand, because if you don't know what we had in the past, it's hard to understand what we're getting into now. Back in 1992, Quill Corporation versus North Dakota was decided at the Supreme Court level, and it held that use tax nexus requires a physical presence. Nexus within a state requires a business to register and collect tax on taxable sales, and without a physical presence, there was no requirement to register and collect tax on taxable transactions. So you basically had to have a physical presence, or you didn't have to comply with the state law around collecting use tax. At that point, it was up to the customer to have to accrue the tax and pay it themselves. It didn't make the property or the transactions exempt. It just meant that the company doing the selling did not have to collect the tax. And so typically, nexus was created for activities of sales and use tax purposes, with typically involved at least one of the following types of activities. You had a physical location, if you had activity of people, and that would include like affiliates, trade show attendance, things like that, salespeople running around. If you had sales advertising within a state on a continuous, regular, seasonal, or systemic basis, and that would typically be through newspapers or periodicals within a state, or on billboards, posters, things like that. If you had the delivery of tangible personal property other than by common carrier, and that was basically if you're running your own trucks into the state, or you had employees delivering it on the company's behalf within the state. Corporate ownership tended to create it. Nexus is the same corporation would own multiple companies under the same trade name within the state. That could create it. And then ownership of tangible property inventory, including property leased out or consigned inventory. And you'll find out that that's kind of one of the problems that the Amazon FBA sellers ran into, because they own tangible personal property at those various Amazon warehouses, and that was causing them to have nexus in multiple states. So the next part is, without physical presence, retailers didn't have to collect use tax, but that didn't mean, as I said, that the tax wasn't due and owed by the purchasers. So what the problem was, a vast number of these individual purchasers made it almost impossible for states to enforce the requirement that they pay use tax, resulting in a very low compliance rate and a lot of lost revenue for the states. I mean, the estimates were basically in the billions of dollars of lost sales tax revenue. So with all this money that was not being collected by the states, they began to implement new rules to try and address this lack of compliance. And this took a number of different tacks. They initially started out by forming a streamlined sales and use tax agreement, which was a consortium of states. They looked to affiliate nexus, click-through nexus, marketplace net provider nexus, notice and reporting requirements, and finally they moved to economic nexus. Now, it's important to realize that the alternative methods of establishing nexus that are listed above, and in addition to physical nexus, they are not affected by Wayfair. So Wayfair only addressed the physical presence. All the other nexus means are still in effect. So if you had one of those, this Wayfair decision did not eliminate it. So a brief history on the streamlined sales and use tax agreement. Basically, one reason for the physical presence requirement under Quill was the complexity of states' laws and the difficulty retailers faced in complying with those laws. And that was called out in the decision. The Streamlined Sales Tax Project was an attempt by the states to reduce those differences and create a more simple and uniform method that would show the courts and Congress that those old problems no longer existed. It basically had 4 major requirements that member states had to comply with. It was a state level administration, meaning the returns were filed with a single state agency. You didn't have multiple reporting requirements on a state and local level. You had to have a uniform tax base. So every state would have to have the same tax base. Goods and services would be taxed or exempt the same in each state. You had the simplified tax rates, which meant the same tax rate applied to items at any location within the state. There'd be no more different rates among a single state, with the exception of food and drugs. Then the last requirement was uniform sales sourcing rules. And what that meant was for in-state sales, origin sourcing would be applied. Tax would be collected based on where the vendor was located, not where they were shipping to. Origin-based sourcing is only used in not a lot of states. So that would have been a major requirement for many states to comply with. For sales crossing state lines, destination sourcing would apply, and the tax would be based on the rate in effect at the destination of sale. That's not changed. That's the way it is now. Surprisingly, 23 states became full members, and 1 more became associate member of the SSUTA. So they try to do this to get all the states to conform, so they can go back to Congress and say, look, we've got our act together, and they can't even get half of them to agree to it. So that was the first problem with trying to get Quill overturned. The next attempt they did was affiliate nexus. And this is basically taxpayers that are related entities who are similar businesses can create nexus for all the affiliates. And this went back to a Barnes & Noble case in the state of New Mexico. The New Mexico Supreme Court ruled the online retailer who had no physical presence in New Mexico had nexus in that state because of nexus of an affiliated corporation that was in Mexico. Basically what they had was retail stores of the company's sister corporation were in New Mexico. They displayed the taxpayer's website at the retail stores. They shared trademarks with the sister corporation that had nexus. The company had cross-marketing activity with the sister corporation in New Mexico to help maintain its in-state market. All of those things combined together, and the New Mexico Supreme Court said, no, you're really all one company, and the activities of your affiliate give you nexus as well, even though you don't have a physical presence. Most states have enacted affiliate nexus provisions. Common ownership, however, is not sufficient to create affiliate nexus. One affiliate must be doing something for the other to help maintain its market. And that could be anything from accepting returns from the other affiliate, gift cards that are redeemable at either company, cross-marketing campaigns, anything like that is going to be sufficient to create nexus, but it has to be more than just one company owning another. So the next one, and I think probably most people have heard of this, is the Amazon law, and that's click-through nexus. And the goal of these nexus laws were to get our large online retailers such as Amazon to start collecting tax. They couldn't get all the small companies that were doing the selling through Amazon to start collecting the tax. So they tried to get Amazon to do it for them. The click-through nexus occurs when an in-state website operator refers a certain level or amount of sales to a remote seller through links on their websites. The out-of-state company pays the in-state residents to host links on their websites to help maintain or generate a market in that state and the states began to view these in-state residents as affiliates. Basically, what was happening was these remote sellers were acting as the in lieu of the affiliates or of their third-party sellers or remote sellers, and were taking the place of them. So the states kind of viewed them as kind of the affiliate nexus, creating entities that we just discussed, and it created a nexus for the remote seller as well. Typically, those thresholds or de minimis standards existed before Nexus was triggered, and normally those were about $10,000 in in-state sales during the previous 4 quarters. These thresholds are not uniform among the states, though. So they tried to exclude the very small, out of your home type companies, or maybe you're selling just a few things on eBay or something like that. And so they tried to make some exclusions for that, but the thresholds of $10,000 are still pretty low. The next one is Marketplace Nexus. And Marketplace Nexus was marketplace providers. They can be any person or affiliated person that facilitates the sale of a taxable item at retail by offering a platform for the third-party merchants to sell tangible personal property, and is serving as the primary point of contact for customer service, processing payments, and controlling the fulfillment process. Again, it's typically marketplace providers or companies like Amazon or eBay, and the marketplace providers are considered retailers that are making sales on behalf of those third-party merchants. The nexus requirements of those marketplace providers to be responsible for collecting and remitting the use tax on the gross receipts from those sales. So that's a little bit different than what we just talked about, in that they were now saying, okay, you're selling for all these small companies, and we know we can't get them to do the collection of the tax. So instead, we want you, large company like Amazon, to do all that tax collection for them and be responsible for that. As you can imagine, that was not greeted well by a lot of these companies, and there were only a handful of states that have enacted this type of provision. The most recent, or is fairly recent, effort has been under the notification and reporting requirements. And these have been around for a few years now. And these are statutes require retailers that are not required to collect and remit use tax on sales that they make in the state because they don't have sufficient nexus to instead comply with notice and reporting requirements. Generally, these provisions require that retailers cannot advertise their sales as having no sales tax. They must engage in point-of-sale notices to customers, informing them that the use tax may be due on the purchase. And that's typically done through specific wording that's required on an invoice. They also require that annual or quarterly reports to customers be filed summarizing the amount of their purchases, and also letting those customers know they have a use tax obligation. Then finally, they also want you to file reports to the states summarizing the transactions that you made to in-state customers. And that basically tells the state who they need to be getting use tax returns from. There was a lot of concern about, can they actually do this? And it went to the 10th Circuit Court, which held that they can be, out-of-state taxpayers can be required to do this because it's an information return, not a tax return. So even though you don't have a physical presence in the state, you don't have nexus in the state, this is not a nexus issue. It's an information issue, so tax is not being imposed, so they can tell out-of-state taxpayers to do this. And it's normally provided by the state as an alternative to economic tax or economic nexus. The reason behind these notice and reporting requirements, they're really designed to make it difficult for the taxpayer to operate without voluntarily registering to collect sales tax. They have penalties that can range anywhere from nothing at all, where the state may not even have a penalty provision, to thousands of dollars. I mean, they can be really onerous on the penalties. And again, all it is really kind of a carrot and stick approach that the states are using to say, if you don't want to voluntarily register to collect sales tax or collect use tax on your transactions to our customers, then we're going to make you pretty much give us an audit report so we can go back to those customers ourselves. An interesting case happened when this first came out. Newegg, which is a very large online retailer, they didn't want to comply with the voluntary registration for Nexus, so they said, okay, fine, we will file the notice and reporting requirements. When that got out on social media that Newegg was following those requirements with the state and providing the state with a list of all their customers, the social media basically blew up on them. It went crazy. All their customers, all their, the people that follow them, just went into an uproar. And within a couple of days, Newegg had went ahead and volunteered to collect tax in the state of Massachusetts. So at the end of the day, the state got the result that it was looking for, and that it got this major online retailer to voluntarily register to collect sales tax. So it's very difficult. It puts the business in a very difficult position, because it either tells them you have to collect the tax or you have to give us the information on your customers. Neither is a very good option. And finally, we get to economic nexus. And what happened was that the states were not satisfied with the click-through and the affiliate nexus rules, and they were frustrated with the lack of progress by Congress and the Supreme Court's refusal to address Quill. Remember, this all happened back in '92. So we're talking about 20 years later, and still nothing has been done with Quill to address the issues. And the states are saying this is a whole different economy that we're facing than what was decided under the Quill case. So the states basically took it among themselves to become more aggressive in their definition of nexus. And it led to the concept of economic nexus. And the statutes of economic nexus at the time were a direct challenge to the physical presence standard established under Quill, because they were saying, we're going to create nexus based on a level of sales, and it doesn't require a physical presence. But the law of the land, as determined under Quill, was it does require a physical presence. So the states were directly at odds with the Supreme Court on this. And the economic nexus was just basically based entirely on dollar amount of sales or number of transactions. So these laws were unconstitutional on that level, but the issue was, how do you fight them? The state is going to come in, they're going to enforce their laws, and they're going to tell the retailer, you can challenge us in court. We would love nothing more than to go revisit Quill. And so the retailer could either take on that challenge and the cost associated with it, or pay the taxes levied under the state's rules. So the state was in they're kind of putting themselves in a good position, and putting retailers at a real disadvantage. And it also, the problem was it went against the rules as they currently were in place. So what happened ultimately was you had the Wayfair decision. So South Dakota enacted the economic nexus rules, and when they did so, they put them in place with a provision that it will be it'll basically be put on hold until a court case takes them up. That happened right away. They brought suit against several companies, one including Wayfair, and that went all the way to the Supreme Court rather quickly. That case was decided on June 21st of this year by a 5-4 majority opinion. So it was a pretty close decision. And in that case, Justice Kennedy wrote that Quill is flawed on its own terms, overturning 50 years of precedent. And what he said was that the physical presence rule is not a necessary interpretation of complete auto's nexus requirement. Quill creates rather than resolves market distortions. It imposes a sort of arbitrary formalistic distinction that the court's modern Commerce Clause precedents disavow, and that a business does not need a physical presence in a state to satisfy the demands of due process. The case went back to the Supreme Court of South Dakota to evaluate the other provisions of complete auto for tests of constitutionality, but those were really kind of mere formalities. The real issue was that this overturned the physical presence test, and the court, the justices that made up the majority opinion were split among it was not the usual coalition that you would expect to see. You had conservative and liberal justices taking both sides. So it was a fairly well mixed bag as far as who was in which side of this. But some of the key factors that were influencing this decision centered around the minimization of the burden of economic nexus that is placed on the out-of-state retailers. The oral arguments were all about how much difficulty is this for companies to be complying with, what kind of burdens is it going to create, is it going to be retroactive, and what happens if it is. And so what they did was, South Dakota, you got to remember, this was a very vanilla case, and it was a very vanilla case for a reason. They wanted the Supreme Court to not have issues to dwell on. So the states were wanting South Dakota to bring this suit forward, not a different state, because one, South Dakota is streamlined sales and use tax state, so it has very standardized laws, as we just discussed, and those standardized laws helped minimize the cost of administration and compliance. There's no provision for retroactivity in that statute. South Dakota had provided a safe harbor of $100,000 or 200 or more separate transactions in the previous or current calendar year. So they had a bright line test that would exclude the very small retailers. And South Dakota taxes everything. So it's very simple to determine the taxability in that state. Tangible personal property, services, digital goods, they're all taxed by South Dakota. So it wasn't hard for the court to get past how difficult it would be for retailers out of state to comply with those states' laws. South Dakota's tax rate, again, is just one rate, regardless of where the customer is in the state. So you didn't have hundreds or thousands of jurisdictions that you had to try and figure out what the rate was that if you were selling into. So under these issues, South Dakota, the case was decided in favor of South Dakota, but we have to remember too that, again, and I want to stress this, the physical presence is the only nexus that was overturned in this, but it does not mean physical presence doesn't create nexus still. It absolutely does, and all the other nexus methodologies are still unaffected and still in force. So those all have to be considered as well when looking at your operations. So next issue is what are the state's reactions to Wayfair? So they've got this ruling. It came down, said physical presence is overturned. We no longer have to follow it. And the reactions are all over the place. And a lot of it depends on the states. In some states, such as North Dakota, they've announced that economic nexus legislation is now effective. So they already had it in place, and they're saying, hey, it's effective at the date the court decided the case. We're moving on, and you better start reporting under it. Hawaii, they had something akin to economic nexus, but they didn't have a sales tax in place. They had something separate, gross excise tax, and they don't consider it a sales tax. So they basically, what they said was, this legislation has no impact on our tax. Our tax is a tax on gross receipts. So we're not impacted by this ruling. We continue to file and require filing as ever, and nothing's changed. Some states have their own pending litigation that needs to be resolved before they can enforce their own economic nexus statutes. There were various SSUTA or streamlined sales tax member states with economic nexus provisions. They've announced their provisions will go in effect prior to 2019. Those include states like Connecticut, Illinois, Kentucky, Oklahoma, Vermont, and a number of other ones as well. Various non-SSUT members have enacted economic provisions, but theirs is a little more complicated because they have to review their laws to see if they're enforceable under Wayfair. And then a number of states without economic nexus provisions have announced that they're reviewing their current provisions to determine what changes need to be made as well so they can enact economic nexus laws. The issues that the states are having is that the vanilla-ness of the South Dakota case has kind of put them in a little bit of a quandary. The court basically said, yeah, this is a very simple regime of tax to file under. It's very easy to do. It shouldn't cause a whole lot of problems for states, for out-of-state companies. But not every state is like South Dakota. Some of them have many different rates. Some of them tax things differently. Some of them have many types of exemptions. Some of them have many different jurisdictions. And all those are issues that they now have to question, will the court uphold if this was to go back to them under new circumstances? So if Missouri, for example, was to impose economic nexus, Missouri has thousands of taxing jurisdictions. They tax things differently, different types of goods. They have a lot of different exemptions. Would that all hold up under the same scrutiny as the Wayfair case did? And there's a lot of concern that it won't. So the states want to be proactive about that, look at their regulations and make the changes that they feel are necessary so that they can enact the economic nexus provisions. Make no mistake that I have no doubt every state will get to economic nexus. The cost to them of not doing so is way too high. They see a lot of money on the table that needs to be collected and is not being collected at the moment. And so they'll probably move heaven and earth to get their rules in such a manner as to be in a position where they think will be upheld by the court if it ever went to that. 36 of 45 states plus DC have a sales tax, have issued legislation adopting in some form economic nexus, or they propose legislation or pending regulations to enact it. So, as I said, they are moving forward with this. There are some that are still trying to evaluate what changes they need to make, but they're getting there, and they're getting there pretty quickly. A few other of the reactions that we've seen from the states are ones like Massachusetts, Ohio, and Rhode Island. They had economic nexus statutes prior to the Wayfair decision, and they're considering retroactive enforcement. They're also being advised not to do this. So as one of the pillars of the South Dakota decision was that it did not provide for retroactive enforcement. If you listen to the oral arguments on the case, that was one of the one of the things that the South Dakota Solicitor General or Attorney General was very adamant about. However, when the United States Solicitor General went up and advocated for South Dakota, he told the court, yeah, of course, it can be enacted retroactively. And you could just kind of hear the groans from the states going, no, that's not what we want. So they made it very clear that they didn't want to do retroactive enforcement, and the court made it very clear that they were not in favor of it. But a few states are considering it. We'll see where that plays out. Several states have also enacted very low economic nexus thresholds at $10,000 of taxable sales. And they're presenting qualifying taxpayers with a choice on this of either doing the registration or complying with the notification and reporting requirements. The notification and reporting requirements also have the same threshold of $10,000. So, it's kind of like they're basically telling the companies, you can do one or the other, but we want something. And 14 states have enacted the notification and reporting requirements. What I've provided here, and this is the most recent map I could come up with and put together. This was basically tell you where the economic nexus states are, which ones have the click-through nexus, the affiliate nexus, their streamlined sales tax states. Again, the streamlined sales tax states have a pretty good road to getting to economic nexus on a fairly fast basis because they're already a fairly simple structure based on following the rules of the SST. So those types of states, I would expect that you'd see economic nexus happen very quickly in the near future with those. Some of the other ones probably going to take a little bit longer, but they may get there in a more roundabout fashion as well. So again, you have the state's reaction to Wayfair, and you have a lot of moving parts going on, a lot of states rushing to enact the economic presence or economic nexus rules and try and start collecting on those things. But it also raises a lot of questions that need to be answered, but they have not really been addressed by the states. So this is all new uncharted territory for the preparers, for the states, for everybody involved, retailers. And so there's a lot of questions that are coming up that probably weren't thought about initially when these statutes were put in place. Some of the ones that are not that they're coming up with are, when is the threshold met? Is this viewed on an annual basis? Is it by a quarter? How is that? Normally what you're finding or what we're seeing is that these are being looked at annually. So they'll look at prior year, or they may be looking at a rolling quarter basis. So they don't really look at a year. They just say, what's the last 4 quarters? And as soon as the last 4 quarters meet the threshold, then you have a filing requirement. Another question that's come up is, do you look at taxable sales or gross sales for meeting the threshold? And in most states, what they're looking at it appears to be gross sales, but some of them do say taxable sales. Some of them are not real clear. There's also the sales. Do they include tangible personal property? Do they include services? Do they include electronic downloads? And that's, again, kind of depends on the state. We've seen all of them. Some of them will include tangible personal property only. Others include all of them. Some of them only include the tangible personal property and services. It just depends on the state and what their rules are. The next question is, what sales should tax be first collected on? Do you start collecting after the threshold is met? Do you collect on the sales that are included in meeting the threshold? So you have 4 quarters, you've now met the threshold that says you have nexus. Well, what about those sales that led up to that nexus? Are they taxable or not? Should you have collected on them? And it's very hard to understand how you can collect on them if you didn't know you were going to meet the threshold, but in some cases, you may be able to project that you're going to. And does that mean those sales should be collected? You should be collecting tax on or not? And generally, I would say that you probably don't have to collect on sales prior to the threshold is met, but there isn't a lot of guidance on this from the states. So again, we're going to have to wait and see what kind of rulings we get, but I don't think that that's something that they're going to require. The next thing is, what differences in facts from South Dakota case would the court find acceptable? And that goes back to where we were talking about streamlined sales tax states versus non-streamlined sales tax states, states with many different thresholds or many different taxable items within the state, or rates, or jurisdictions. Any of those things could cause the Supreme Court, if the case went back up to them in a different state, to say that's too complicated, we're not going to go that far. And I think that's probably the last thing the states want to have happen. So, with that said, it doesn't mean that these states are all uniform with South Dakota. So there are differences out there, and there are some concerns of how different can they be before they fall into it, that type of trap. And the other problem is, who wants to actually take it back to court? That's an expensive proposition, and probably only a very large company is going to be willing to take that on. So we'll just have to see how that shakes out. Next thing is, does a threshold require a business to exceed this total sales amount, total transactions amount, or both? What you typically find in these states is they'll have a threshold for sales, and again, it could be gross, it could be taxable sales, and it'll say $100,000, $200,000, whatever the state says, and 200 transactions, or it may say or 200 transactions, or 100 transactions, or it may not have transactions at all. And so, does it require a business to exceed both, or one or the other? And that, again, has to be determined by the state. It's a state-by-state basis. They're usually pretty good about defining that, but there are some where it's a little unclear if it includes both. What's considered a transaction? And this is a real issue, because that was not defined in the case, and I haven't seen it defined by too many states. But is a transaction, does it consist of multiple items within a single order, or what if they're delivered? What if a single order is delivered over multiple shipments, or you have multiple items on a single PO, or say you had multiple POs, but they were all generated from the same sale instance? What's a transaction? And when you're talking about a threshold of 100 or 200 transactions, that could immediately get you over that threshold if it's interpreted to be items that are purchased. So that's a big concern. And then you have the whole issue about home rule municipal taxes. So basically, a home rule state, or a home rule city, not state but city, is one that can determine its own laws by the state. The state has given it that jurisdiction. They can impose the taxes they see fit. They don't have to have the same taxable items as the state does. They don't have to have the same thresholds as the state does. So what are the home rule cities doing with this? Do the state thresholds apply, or do those sales thresholds have to be met within the city itself? So if you have $100,000 in sales and it's into, say, Idaho, but they're spread out over every city in Idaho, does every city in Idaho have Nexus? Or do you have Nexus and have to report tax in every city in Idaho? Or do you just have to report it in the state? That's not real clear right now. And what we've seen is, in many cases, the cities are saying we'll follow, whatever it is in the state, that gives you, if you have it in the state, you have it in the city. But that's not really how home rule rules work. So they're kind of going against their own home rules with doing that. But what we have found is that it's a lot of times the city is saying, if you have the threshold met in the state, it doesn't matter how much you have in our city. That's sufficient for us. And then you have the impact on drop shippers. So in a drop shipping situation, a lot of times you may have a seller and a supplier, and the seller may not have nexus in the state, but the supplier does, and the supplier has to collect the tax from the seller. And if they can't get a resale exemption, a valid one from the seller, they have to charge a seller tax, and the seller then has to charge tax to the customer, or the customer has to self-accrue the tax. This will probably make things a little easier for drop shippers, because what you're going to find is that the sellers are going to be registering in more states. What's happened in the past is there's been some states, Massachusetts, California, and some others, that will not take a resale certificate that's not issued with their own state ID number and on their own form. But the problem is, to get that resale ID number, you have to register in the state. So if a seller doesn't have a nexus within California, they're probably not going to be registered in California. But now you have a supplier who is drop shipping to a customer in California, and they need a resale certificate from that seller, the person they're selling to, before they can exclude tax on that transaction. Well, you go back, the seller, they don't have nexus in California, they're not registered, so they can't provide a resale certificate. So what happens is the seller ends up paying tax to the vendor, and then the person they're selling to, the ultimate customer who lives in California, also has to pay tax on that transaction, because they don't know that the seller has paid tax to the vendor. But they just know the seller hasn't charged them tax. So now you're having the same transaction being taxed twice. With the economic nexus rules, more of these sellers are going to have to be registered in the states, and that's going to cause them to be more able to provide these types of resale certificates to the vendors, and it should make things a little easier on the drop shipping situation. It's not quite as onerous on some of the tax levels that they currently face. So one ray of hope on this. When I talked about the different jurisdictions that states have, here's a map that kind of shows what it is. And as you can see on the map itself, most states have many jurisdictions. You look at Texas and Missouri, there's thousands. It's just ridiculous. So to try and have retailers from out of state collect tax, and remember, the tax is going to be based on the destination. So in Texas, they're going to have to know potentially almost 1,600 tax rates. That's really hard, especially for the smaller companies. So there's a real big problem for companies facing this issue. The impact to the companies that are operating on this, the economic nexus is more than just e-commerce retailers that's impacting. I mean, it impacts all businesses that are selling across state lines. If you're downloading media content, you're providing the mobile applications, cloud software services, wholesalers, manufacturers who only sell products using an exempt manner, any other business, they all have to be aware of these new economic nexus rules. For example, manufacturers selling products, how does it impact them? Well, if you're selling products across state lines as a manufacturer, you're probably selling to retailers or resellers who are going to retail that product. So normally those types of sales under the old rules wouldn't be taxable because you don't have nexus in that state. Under the new rules, they should still be exempt because you have because they're being sold for resale. But now you have nexus in that state, so you are now required to collect the exemption certificates. In the past, you didn't have nexus, so you didn't have to collect the exemption certificates. If you're a manufacturer and you're selling across state lines, and you may know, yeah, everything I sell is being resold. I don't have to collect, tax on these things. If you're not getting the exemption certificates, you're creating exposure for yourself. An auditor can come in. The first thing they're going to ask for is the exemption certificates on those sales. And if you don't have them, you're going to have a very limited amount of time to go get them. And the problem then becomes you're looking at sales that are 3 years old. Are those customers all still in business? Will they give you the certificate even if they are in business? A lot of different difficulties that can be encountered in trying to get all of them. And if you don't get them, the assessment will be yours. So again, in the past, manufacturers didn't have to collect them because they didn't have nexus in the state. Now, they still don't have to collect tax, but they need to get those certificates, those resale certificates or exemption certificates. Same thing, wholesalers, any company like that. So even though if you're never collecting or paying tax, this case impacts you. There's also an immediate need for businesses to reassess their sales tax exposure. Enforcement for remittance and collection began in economic states beginning in January 1st of 2018. Some of them started then, some of them are, October 1st, some of them are November 1st, a lot of them are January 1st, 2019, but a lot of them are starting very soon or they've already started. So there's a real need to start looking at this issue right away for companies. As I said, the exemption certificates, they need to be collected to support exempt transactions. If you're a publicly traded company, ASC 450 requires reserves for sales tax exposures to be put on the books or risk SEC penalties. So you may not know you have this exposure, but if you're a publicly traded company, you need to be aware of it because you need to have that on your financials. And if this is already in place, it's been in place for a few months in some cases. So depending on the level of sales and transactions you have, it could be an issue for any publicly traded company. If you have an automated accrual system, a lot of times those are automated to self-accrue the tax from certain vendors because it's a taxable transaction, the vendor doesn't charge tax. So an accrual will automatically be generated on transactions from that seller or from that vendor. And if that's already automated, then companies need to revisit that because you may find that vendor is now collecting tax. And if your accrual system is automated to self-accrue it, you may be paying the tax twice. Additionally, there can be a greater chance of receiving nexus questionnaires regarding other taxes. So for example, registrations for sales tax can lead to income tax inquiries, and income tax returns with an in-state sales factor amount on them can lead to sales tax inquiries as well. So basically you're filing an income tax return, it shows, and every state has at least a sales factor. So now you're going to show a sales factor on in-state sales, you're going to show an everywhere sales factor. The state's going to look at that and they're going, so you got in-state sales and they exceed our threshold, but I don't see where you've registered for a sales tax ID number here in our state, and I don't see where you're remitting anything on sales tax. So that's going to start creating some inquiries from the state as well. And then also non-U.S. sellers with no U.S. operations may now be required to register and collect tax on sales that they never had to in the past. So that's a big, that may be a big wake-up call for those ex-U.S. companies that don't have any presence over here, Now all of a sudden they got to start collecting sales tax. So what are the steps needed to start ensuring compliance? First of all, don't overreact. Okay, this is a new changing landscape with many questions that need to be answered still. Businesses, they need to consider first and foremost, what are they selling? Where do they ship their sales, which will be used to determine what laws and rates apply, and how do they sell? So are they drop shipper, e-commerce, whatever. In some cases, it's sales of tangible personal property that meets the threshold. Other ones, it's digital e-commerce, it's services and tangible personal property. You may not meet the threshold depending on what you do. Additionally, to help guide in this understanding, a nexus study is probably a very good idea for states, for businesses with sales into multiple states. It'll bring awareness to the states where the filing obligations exist or will exist. Registrations need to be started as soon as possible for states where filing obligation already exists so that the collection of the tax can begin. You need to understand how the laws in each state impact the taxability of the products, identify whether a municipality taxes items differently. In some cases like Louisiana, the parishes will tend to tax everything and the state not quite so much. So you may find something that's taxable in the parish, but it's not taxable in the state. So you have those types of issues. A process needs to be implemented for collecting and retaining exemptions, certificates, and resale permits, and to begin collecting those in states where exempt sales occur. Precautions need to be taken against duplicating tax payments now that more vendors are charging tax. An evaluation of whether the notice and reporting requirements is a viable alternative to voluntary registration. In some cases, maybe that is the best way to go. It's not what the states want you to do, and it's a fairly onerous process, but it kind of depends on what your business model is. And then if accurate information isn't available for a destination sale, a process needs to be created to determine where the sale should be assigned or where it should be addressed. The states will have a hierarchy of where that sale gets sourced to, but you need to have that information being generated so you can do that. Some final thoughts about this. Again, this is a very new landscape and the rules are changing continually. And unless a business has the resources to monitor and evaluate these changes and the impact that's going to have on them, it's definitely a good idea to consult with their tax advisor on this subject, because somebody needs to monitor this going forward, and that's typically going to be the accounting firms or your tax advisor. Owners who are looking to sell a business should have their activity reviewed in light of the economic nexus rules to determine if the business has sales tax exposure that might create a reserve of the sales price. You don't want to go in and selling a business and then them come back and say, well, you got a $2 million sales tax exposure that you didn't know about, but we're just going to take that right off the sale price. We'll hold on to it and give it to you at the end of the 3 or 5 year period or whatever we escrow it for. And I can guarantee you probably never see that money. Businesses that are looking to acquire other entities should also engage in that type of review. So, you don't want to be buying somebody who's got all that exposure, because that liability will come with the purchase. And that can actually happen on asset purchases as well. Then the last thing is contractual arrangements don't change the law. So if you're responsible for the tax, if you write into the contract that you're not responsible, that doesn't make you not responsible. So just because the contract says it doesn't get you off the hook. And with that, I'd like to see if there are any questions.
Yes, Rich, we have one question here. How long does it take to get registered with the state once you've met the threshold?
Okay, that's a good question, and like most things with the states, it takes it kind of varies. In some states, it can be almost immediately. You can do it over the internet. It doesn't take very long at all. Other states can take quite a bit of time. Typically, those ones that some states will require you to be registered with the Secretary of State first to get that ID, and then you can register for a sales tax ID. Other states do not require that, and you just get the sales tax ID number. In California, for example, you have to register with the Secretary of State, and while the registration for the sales tax ID can take a matter of minutes over the internet, the Secretary of State one is a physical form that has to be mailed, processed. It takes 3 weeks or more sometimes to get that back. So, and you can't do the sales tax registration without it. So you kind of get put behind the 8 ball in some cases. So again, it just depends on the state. Anything else?
Well, we have a few other questions, Rich, but I think we're out of time. So I just want those who have submitted questions to know that we will get back to you personally and answer your questions. So that concludes today's presentation. We again ask you to complete the questionnaire that will be emailed to you, and we thank you for attending.